We recently modeled it in a preliminary economic assessment as building a nameplate capacity of 37,000 tons per year of nickel over a 37-year mine life. So it's really one of the giant projects.
Welcome viewers tuning in to this edition of Assay TV, where we're gaining an insight to Giga Corporation, the company developing a large nickel and cobalt sulphide deposit in British Columbia. Speaking with Mark Jarvis, who's CEO and director. Mark, welcome. How are you?
I'm very good, Adam. How are you doing?
Yeah, I'm good, thank you. Thanks for speaking with Assay TV. So I wonder if we could start by introducing the Turnagain Project, and for some of the viewers that might be new to Giga Metals, could you introduce some of the attributes of this project in particular?
Sure. Well, it's a very large, low-grade deposit of nickel and cobalt and sulfides, open pittable with an extremely low strip ratio, located in north central British Columbia. And so we've been working on this for quite a few years. I've actually been involved with this since 2004. Massive project, very difficult to get a big project like this off the ground. We recently modeled it in a preliminary economic assessment as building a nameplate capacity of 37,000 tons per year of nickel over a 37-year mine life. So it's really one of the giant projects of the world. We've recently completed a season of drilling and other work to collect data with the goal of getting enough data together to support pre-feasibility. So just more detailed information.
Certainly.
Yeah.
Excellent. Well, we'll go into some more specific updates on the project so far. But one of the key things that stood out for us was that you're producing this nickel mine in Canada, and you want to be a carbon neutral, or certainly a very high performing on
Sure.
environmental standards project. Could you talk about the strategy and some of the innovations that are going to get you there?
Sure. Well, to begin with, sulfide deposits, just by their nature have a lower carbon footprint than, oxide deposits such as laterites, HPL projects and so forth. We also have the benefit of access to the British Columbia hydro grid. So our power source will be, very low carbon. And, just modeled on the basis of that, and on the assumption that we would use a diesel mining fleet, we estimated in our PEA that our carbon footprint would be about 2.4 tons of CO2 equivalent per ton of nickel produced for scope 1 and 2 emissions. And that right there is at the very, very, very low end of carbon intensity of probable nickel projects from information we've got from Wood Mackenzie. Now, if you could use an electric mining fleet, which does not exist today, but which is where we think the market is moving very rapidly, you could get your emissions down to less than 0.7 to 1. And then it gets interesting. We're looking at sequestering CO2 from the atmosphere passively in our tailings, and we're working in conjunction with a consortium of other companies and the government of Canada, with a professor at the University of British Columbia named Dr. Greg Dipple, who's been studying this for about 16 years. Mount Keith in Australia, a nickel mine, in warm weather. Diavik mines in the Northwest Territories in Canada, so a diamond mine in cold weather. And he's developed a methodology to measure the uptake of CO2 into a silicate tailings pile. So what happens is silicate rocks exposed to the atmosphere absorb CO2 and convert into carbonate minerals. And they do this all around you all the time, very, very slowly. Now, if you take the silicate rocks and grind them up, as we would, in a mine to to extract the valuable sulfide minerals from them, then what's left is silicate sand residue, which we would spread out in beaches in our tailings management facility so that they could readily absorb the CO2 from the atmosphere. And, based on work that we've done so far on our material with Dr. Dipple, we figure that that would get us down to carbon neutral. And this work is ongoing. We've got a long ways to go, but it's very encouraging so far. And it's very interesting. So, maybe if we could develop the methodology further, we would have carbon credits that we could sell as a revenue stream from the project. So not inconceivable, put it that way.
Certainly, this is a real innovation. And just keeping on the theme of sort of scope 1 and 2 and 3 emissions, presumably once the project develops and you have more of a value chain established, it will be more localized, regionalized, so North American servicing, and that in turn would help out with the scope 3 element as well of who you're selling your nickel sulfide to, or your end product, sorry.
Sure, and in fact, there's a couple of elements to that. One is that, as they try to develop the electric vehicle business in North America, a lot of the people that are planning gigafactories in North America are hoping to source their raw materials from North America. Again, because of these scope 3 emission concerns, but also for reliability of supply. Right now, the world is in an interesting place because, the Chinese have behaved very strategically and have been working very hard for, at least a decade to develop their supply chains for batteries, for lithium-ion batteries. They've got their supply chain figured out for cobalt, for lithium, and for nickel. And I'm mostly concerned with the nickel element. The Chinese have been securing long-term supplies by building mines in places like Papua New Guinea and Indonesia, close to home. Mines that are uneconomic in Western terms. Even the successful HPAL projects have been getting built with an internal rate of return that we figure is 1%, 2%, or 3%. So, it's an interesting question why these projects are getting built. Basically, I think the Chinese are being very strategic by, investing in a project at a low internal rate of return. Their cost of capital is pretty cheap, and their access to capital is pretty good. So, basically, they'll bite the bullet of spending $3 billion to develop a 35,000 ton per year mine. But then they've got that long-term supply of nickel and cobalt at the cost of production. So, it's the equivalent of a long-term fixed price contract. And they've done this several times. Whereas Western companies would never build mines with that kind of internal rate of return. And then we look at our project, which is a sulfide project. It's low grade. Our economics are not great at the low end of the commodity price cycle, but they are better than HPAL economic. And but we're in a Western jurisdiction, so. I think one of the reasons our project isn't built and the HPAL projects are built is that, in Canada, we face, a rigorous environmental assessment. You can't just walk in and, pay someone for a license. And it's a bit of a different, jurisdiction. So that element of being difficult, in terms of having to do rigorous environmental assessments is a double-edged sword. It does slow the project down. It does make it more difficult to get built. However, in Canada, large projects like this do get built. But it also means that if you're a customer of the products of the nickel and cobalt from a Canadian mine, you can be happy about the ethical implications. You're not destroying the environment to get the materials you need for your electric vehicle. And if you look at some of the operations in the Coral Triangle in the Pacific Ocean, it's pretty hard to say that. It's pretty hard to say that you're saving the planet by driving an electric vehicle sourced that way.
Certainly. Let's quickly focus on cobalt. Do you have that purely as a byproduct? Is the upside there purely advantageous to you? Are you going to do anything within your strategy with cobalt that you might find?
Well, it's funny. Our concentrate is 18% nickel, 1% cobalt, and so an 18-to-1 ratio. And it's kind of interesting in that, as you watch the evolution of lithium-ion batteries, at some point, I think we're going to end up at about that ratio in the cathode of 18-to-1, maybe. Right now, money is being spent to increase the percentage of nickel in the cathode because the nickel is what holds the electrons. And so, put simply, if you want your car to go farther on a single charge, you need more nickel. You need a higher percentage of nickel in the cathode. And it's not a trivial research project because the more nickel you pack into the cathode, the more volatile it is because you're simply cramming more electrons into a given volume. So there's more of a tendency for this thermal runaway. I think the energy density is going to increase substantially with the development of solid-state lithium-ion batteries, and it'll be very, very good for nickel.
Let's quickly look under the hood of the company, though. Again, for viewers who are interested, investors, how are your company financials? Is your drilling funded for this next phase?
Well, we just finished spending a lot of money up at the property, and we will probably need to be doing a raise by the end of the first quarter of next year. Frankly, we're hoping that we can conclude some sort of a deal at the project level with the strategic. We've got a number of conversations going on, and that would be our preferred mode of financing, is to dilute at the project level rather than at the equity level. The math just makes more sense for our shareholders. And we'd like to do a significant deal there. In the alternative, we're of the theory that we should just drive this project forward, and we'll do equity raises if we have to. The question sometimes comes up: why don't you just sit on your asset and do nothing and wait for the market to come to you? Well, it's something we have considered. In fact, it's something that we've done. During the period between, say 2011 and 2017, there was no money available for development of a project like this. And so we did just hunker down, spend very little money, hang on to the asset. And, we basically came out the other side of that down market. So we're practiced doing that. We know how to do that. But we just think that the more we de-risk the project, the more we advance the project, when the time comes, the better the shareholders will do. So,
yeah, absolutely. It's a much better period now than you've endured.
Yes.
So what can investors look forward to as the key milestones then, as we look into 2022?
Well, I think if it happens, and there's no guarantees, obviously, but doing a transaction with a strategic at the project level would be a transformative event for our company. And that sort of thing would obviously cause a re-rating, I think, in the stock. And all I can say about that is that I'm sensing that some of the strategics are getting ready to come to market, and we'll see. It's going to be interesting when things start happening. Absent that, and again, there's no guarantees that anything will happen. But absent that, then we will carry on. We're doing optimization studies of our project and trying to figure out exactly what the PFS should look like. And the PFS is a very important stage of development here. So, because until we have a PFS, we're not going to submit a project description that would kick off the environmental assessment process. We had to have a very clear and confident view of what our project looks like. And we're still, we're getting there. One of the things we're considering, for example, is, instead of modeling this as a project that will produce a concentrate to sell to a smelter, we're considering the possibility of bolting on a further circuit to convert our concentrate to mixed hydroxide precipitates, because that is the form of nickel and cobalt that the market wants. That would cost obviously extra capex. You're bolting on a POX circuit to the end. It adds to your operating costs. It'll also add to our carbon footprint. So that'll make our goal of being carbon neutral more challenging, but not that much. And then you'll have a product that is extremely desirable for battery manufacturers. We know that we can make a product that is 49% combined nickel and cobalt with very low deleterious elements. And currently, the payables on MHP are 90% plus for both nickel and cobalt, whereas the payables for a smelter, well, what we modeled in our PEA was 78% payable for nickel and 35% for cobalt by selling to a smelter. So the increase in payables alone would, I think, more than pay for, we would be assuming long-term that you get payables more in the 85% range, probably. That's from the best market intelligence and forecasting that we can have at this point. But also, we could decrease the grade of concentrate that we produce to feed to the MHP facility and increase our recoveries significantly. And we're doing trade-off studies to find the sweet spot. It's looking like the sweet spot would be somewhere around a 12% concentrate. And we could significantly increase our recoveries. So between the increase in recoveries and the increase in payabilities, we think that producing MHP would be economically accretive to this project.
Certainly. Well, there we have it. Mark, thanks very much for that rundown. It's really interesting to get your views on the project, state of the market at the moment, and everything sounds quite positive as we look towards the end of this year. So hopefully we can catch up with you in 2022 for an update on Giga.
Well, fingers crossed, Adam, and thank you very much for your time.
Thanks for speaking with Assay TV.